Monopoly Hybrid.
Welcome to Monopoly. Yet another episode. We are at season 6, episode number 2. We're going to talk about property finance. And for that, we have a specialist in property finance from Maybank. His name is Toar, and he has over 20 years of experience. Welcome to Monopoly, Toar.
Thank you. Thank you for having me. It's a very exciting time to be around and talking about property and finance.
Before we get into it, have you played Monopoly as a kid?
I have, yes. I used to love playing it with my parents and with my friends. Yeah, absolutely.
What was your favorite move?
My favorite move? Buy everything, basically. Yeah. I love to be the banker, obviously. But no, it was great.
Yeah.
They used to go on for hours. Yeah.
The reason I asked that was the brainchild behind this podcast.
Of course, yeah.
The reason we call Monopoly is it's similar to everyday life in
Absolutely.
what we play with the properties right now.
Yeah. No, look, I've got 2 young kids and they're still maybe a bit too young to play, but I can't wait until we get that out and start playing with them. That'll be great. Yeah. Yeah.
So talking about finance, I mean, there's a lot of people who wants to get into the property market.
Mm-hmm. Yeah.
But really, they should be asking 2 questions for themselves, right? One is, how much money have I got to put as a deposit, and how much can I borrow? And that's where you come in and help them out.
Absolutely, yeah. Look, the Melbourne property market's heating up at the moment. I'm having a lot of discussions with people, and there's 2 main questions, like you say. The first one will be your income versus your expenses, quite simply, right? And then it's how much equity or savings you've got. Now, when I talk to people, there's kind of 2 strategies that I take. For the first one, it's if someone is looking for an immediate need. They have to buy a property right now. Obviously, we discuss what their situation is. And the other one is preparing for the future, because not everyone's, especially in the Melbourne market, it's getting hot again. I'm sure you know this, but, your average properties are starting to hit almost $1 million now. So my job is to find solutions for people, because sometimes it's not that easy. There's different strategies that we can use to help people out. Yeah. Mm.
And if you talk about the fundamentals of lending, say someone comes in, when we are lending to a client, what are the fundamentals or essential fundamentals they need to have to get started?
Absolutely. So, like I said before, the income versus the expenses. So I think obviously there's different sources of income. You've got, work, PAYG. There's self-employed people. There's investors. I've been doing this job for 20 years now, and I've got, people with property portfolios, and they've got trusts and companies and blah, blah, blah. So there's many different ways, I suppose, that you can prove your income. And my job is to sit with someone and really explain, the details of what they need to do to prepare, and make sure that when they apply for a loan, they're not just throwing darts at a wall, that they get all themselves prepared, so that by the time the bank or the credit assessor has a look, there's no questions, and it flies through quickly. In my experience, sometimes I get people that have had bad experience with other lenders where they've gone back and forth, whereas, the way I like to do it is get it right in the first place and just really get it through. The other side of things is the equity or the savings. And again, there's different situations for different people, like genuine savings, or if you're getting a gift from a parent, how does it work? How long does it have to be in there for? So, I spend a lot of my time sort of explaining to people how to get the application perfect, so that when it's ready to go through, it just flies through. Yeah.
And it's in the best interest of them, because it's you're advising them what to do. Sometimes client might not be ready, but then your advice will be gold for them to get prepared in the next 6 to 9 to 12 months.
Absolutely. Look, there's a third element. We talked about income, expenses, savings, and equity. The other one is the credit score. Okay, so a lot of people get confused with how credit scores work in Australia versus America. You don't need to have a credit card. You don't need to have existing finance to get a good score. Over here, it works backwards, actually. So everyone starts off with 1,000 points, let's say, and the more you miss payments or apply for finance, it actually goes down. So how that's relevant is when you're dealing with an inexperienced lender who's kind of just throwing darts at a wall, trying different lenders, it's actually impacting your credit score. So what I find is it's worth sitting with someone who's experienced to really say, maybe you don't get the answer that you want. You're applying for a 600 grand loan and maybe you can only do 400 at this moment. There might be some people out there that can push, trying to get it through, but it's going to impact your credit score if it's not 100%. So what I like to do with people is think about the long-term strategy, right? Yeah. Obviously, you guys are property advocates and whatnot. I deal with a lot of advocates as well, and myself, I've owned several properties, so I know what it's like not to push too hard for maybe the first one and work your way slowly, right? The first property my wife and I lived in was a 260 grand property in Hoppers Crossing, and 15 years later, now we're in a multi-million dollar property, and it's taken a while to get there. So I think a lot of kids these days, I sound old, don't I? A lot of kids these days, they want the mansion straight away, but I think there's something worth moving slowly to build your portfolio. Yeah.
It's an excellent point what you brought up, Tao, regarding the credit score. It's a misconception that people need to have credit cards for you to have a good credit score.
100%.
In fact, it's actually the opposite, complete opposite.
I think there's, a lot of people will watch television and a lot of content is American and that's how it works over there. In America, the interest rate that you get is based on your credit score. So if you have a bad credit score, you get a bad interest rate. In Australia, everybody is able to get a similar interest rate, right? Regardless of your score. What the banks do instead is they look at your equity position. If you have 60% or below lending, you get a much better score, much better interest rate, versus if you're 80% and then if you're 90%, you get an even worse interest rate. So these are the kinds of things that I'll talk through with people because, look, some people, they have no choice. Like I said before, they have an immediate need. They need a house. Well, you're going to have to maybe get a lender's mortgage insurance, okay? But for people who can wait or who can find other sources from parents, from brothers, from sisters, from friends, to help reduce the amount of money they need to borrow, it will improve their interest rate. So absolutely, yeah.
And then there's another segment of people. They come to us to buy a property. They want to go for a loan or a mortgage, but they have a bunch of personal loans.
Yeah.
Again, that will also have an impact on their ability to lend.
Absolutely. Yeah. And surprisingly, though, it's different for different people. I'll give you an example. So obviously, it's if you have more personal loans, car loans, credit cards, it's going to reduce your borrowing power.
Yeah.
And so for some people, they'll need to work at closing them off before they can borrow what they need to.
Yeah.
But on the flip side, there are people who earn really good income. They might be on 150 grand a year, 200 grand a year, but they have no deposit.
Yeah.
And so if they're planning to buy a property in a year or two, it might actually make sense for them to get the car on a lease because you want to put your cash into your savings.
Yeah.
So it's different horses for different courses, I suppose. Yeah.
Correct.
So you're absolutely right. For the majority of people, having personal debt is going to reduce what you can borrow.
Yeah.
But for other people who have really good incomes, but no savings,
correct,
sometimes it's worth it to have the debt and pump as much money into the savings as you can. Yeah.
And every conversation we have with the client is different. Everybody is different. Every situation is different.
Yeah.
And mostly it's not about a single property purchase.
Yes.
I mean, we are thinking 10, 20, 30 years time.
Absolutely.
What are they trying to achieve?
Yeah.
And it's our duty to help them to go where they want to go.
Yeah.
So it's about a long-term strategy overall, I guess.
Absolutely. I think having done this job for 20 years and having invested in properties myself, there's a lot of lessons that I learn from all sorts of different, demographics of people. Like one customer comes to mind where, they husband and wife, they work in very modest. The wife works at Woolworths. Husband's got a very sort of not a very high income job as a mechanic, but they're on their sixth property, right? And that's because their probably frugal. That's part of it as well. Is you got to think about your expenses. It's not just about the income that you make. Sometimes I deal with doctors earning hundreds of $1,000s a year, but they're spending so much money. So I'm not sure if I'm sure you have read Rich Dad Poor Dad. So you've got to remember the expense side of things as well, and planning ahead is very important to me. I think that's really important to talk about the long-term journey. Yeah.
Yeah. And also, a lot of people are not aware of the equity factor. Sometimes we meet people, they have bought properties years ago and they have been sitting on hundreds of thousands of equity without not knowing.
Absolutely.
Which they can make use of and create a portfolio for themselves just by the equity.
Yes, 100%. Look, I've just recently done this myself, so I can talk about that in a minute. But recently, obviously, Melbourne felt it the most during COVID with all the lockdowns and whatnot. And there was a big surge of people that decided to buy properties interstate, right? Now, I've got a lot of sort of baby boomers who have built equity in their home, and they're looking to maybe retire at some point in Queensland or whatever, right? Now, the way that purchasing a property in Queensland is very different to here. They have very short settlement periods, and they don't like subject to finance. So a lot of my customers, what they've been able to do is release their equity, not an approval in principle, but literally have the money ready so that when you see something, you literally just buy it. Okay. So again, I've just done that myself in August last year, working with a buyer's advocate that found me a property in Rockhampton. And the perfect one came up. I didn't have time to get pre-approvals and do valuations and whatnot. Had the money ready, bought the property, and then I can sort it out later in terms of how to structure it and things like that. So time is of the essence sometimes, and having equity is a great way to do that. And a lot of people will ask me about, how does it work from a tax perspective and risk? Like, obviously, I'm not an accountant. With my experience, what I can do is I can help people ask the right questions. So I don't give advice, but instead of going to an accountant and spending hours paying per hour to speak to the accountant, get the basics off me first, so that by the time you hit the accountant, you've got very specific questions to ask. So yeah, lots of people with equity and not really aware of how to utilize that. Yeah.
And when it comes to self-employed people, I mean, that's another ball game altogether.
Yeah,
right? It's a lot different to PAYG.
Yes.
If you can discuss around that as well, how best to prepare if you're self-employed.
Absolutely. Look, a long time ago, we used to look at self-employed in a number of different ways.
Yeah.
But unfortunately, banks these days are pretty cut and dry.
Yep.
So you have to have your tax returns completed.
Correct.
Okay. But where we can work around the edges is, especially with people with multiple companies, they might have a company that holds where they operate out of. They might have a company that operates and one that owns equipment and whatnot. So again, it's about dealing with someone that understands how it all works. Because what I've found is when you present your case to a credit officer or a bank, credit officers, if it looks too difficult, they'll say no by default.
Yeah.
Okay. So my job, and when I'm teaching some of the new guys of how to do it, is to understand the business inside out. What do they do?
Yeah.
What does how do each entities relate to each other?
Yeah.
Are there other business partners? Are there this and that? The more you can present something to a credit officer and it's very clear and concise, it'll make their job easier, and they'll give you a quick yes.
Yeah.
Yeah, I'm very much, my focus is always like a quick yes.
Yeah.
And if it's a no, then it's a maybe later.
Yeah.
But what we don't want is to go back and forth and ask for this document and that document. And it can be a bit cumbersome. But yeah, that's my experience with self-employed is really just, it's hard to get around things, but if you're going to do it properly.
Yeah. And a lot of other questions people have is which structure is the best suited? Again, it all depends on their situation.
Absolutely,
right? some people buy it under company, some people buy under family trust, unit trust,
Yep.
and so forth. How would you advise? Say, for example, someone wants to buy it under family trust. Is that different to an individual in terms of lending point of view?
Absolutely, yeah. There's a lot of sort of tips and tricks, I would say, in how you certain banks will look at a family trust. Some of them will separate it completely to the individual. Some of them will still include it.
Yeah.
But the very important point that you've made is that it's going to be different for different people.
Yeah.
I think that as a starting point, what you want to do is talk about your goals, right? So structure, and some people will see in the news, Warren Buffett's done it this way. Yeah, but that's Warren Buffett. So you've got to start somewhere, and it depends on different situations. So, if you have a smaller portfolio, maybe you don't want to set up all these companies. But if you're planning to grow over time, then maybe you can start early. But I think the most important point here is that an accountant is the person that's going to give the advice. The role of someone like myself or yourself is that we can help the person understand the different considerations for each of the structures.
Yeah.
So that they can see how it will impact them over time.
Yeah.
Okay, from tax perspective and all that. From a maybe they've got kids that are getting older and how they're going to distribute the income and all that. So, but I think the point is that my job is to inform people about all the different options, about how that will impact this property and the next one and what's next.
Yeah.
But at the end of the day, you really need to speak to an accountant.
Correct.
Who's going to give that final advice.
Yeah.
But my job is to, because look, there's so much information out there.
Yeah.
How do you cut away all the nonsense, basically?
Yeah.
Because there's a lot of spruikers out there that will say do this, do that, but I like to keep it simple.
Yeah.
To be honest. Yeah.
Absolutely. Yeah. And it all needs a professional piece of advice from accountant in terms of the structuring.
Yes.
But it all can be done based on the situation.
Yeah. And the guidance is where I can help, and other experienced people. And I think where that comes from is doing it myself.
Yeah.
And trialing and erroring. There's a lot of stuff I did, 15 years ago that I probably would have done differently.
That makes a big difference.
100%, yeah.
That's pure experience.
It's exactly. Like, don't talk to me about the capital gains bill last year. So, but in terms of customers that I see, and to be honest with you, like I actually graduated with an IT degree, believe it or not.
Same with me.
Yeah, there you go. And I'm sure a similar thing happened where I love property so much, and slowly I worked into the position that I'm in now, doing home loans. But the thing that I love about this job is seeing what different people do. Yeah. Right. I learn a lot from my clients.
Yeah.
And seeing what the ones that are successful, the ones that get themselves into trouble.
Yeah.
And that's what I do with my customers is I can share the different experiences with them.
Yeah.
So it's very far from advice.
Yeah.
It's more, hey, these are the things you should think about.
Yeah.
And that's based from personal experience and seeing other people do it as well. Yeah.
And that's how you learn.
Absolutely.
Yeah. Learn from the mistakes of other people have done.
Yeah.
To do that.
Yeah.
And talk of the town, interest rates. What are your thoughts? Did the RBA have the meeting yesterday about the interest rates, or is it next week?
So what are we in May? So the talk is that there's going to be another rate cut.
Yeah.
A lot of banks have already reduced their fixed rates.
Yeah.
And that's an interesting conversation that I'm having with a lot of people at the moment.
Yeah.
But yeah, the talk is basically there's going to be at least another 1 or 2 interest rate cuts. And I know that that's a hot topic, as you mentioned. And obviously, I'll spend a lot of time with people talking about what's the best rate that they can get at the moment. But my approach is always a little bit more long-term. A thing that happened obviously during COVID is like, I was talking to people about 2%, 1.79%, and then all of a sudden it's gone to 6%. What do you do? So a lot of it is about, preparing yourself for that, having buffers and things like that. So yes, rates are going to drop, and maybe for the next 3 to 5 years, you might plan for it to continue to go down. But if you're looking at a 10-year, 20-year sort of strategy, yeah, there are certain things to think about. And I think the basic thing will be obviously, deciding between fixed and variable. What are the pros and cons to those? But yeah, rates are looking good. I think that's why I'm getting busier of late. People are starting to be more confident about what to do out there. But yeah, I think rates are ever fluctuate. I think having done this for 20 years, the analogy that I use for my customers when they talk to me about rates, the ABC did this thing about 7 or 8 years ago, where they got 3 economists to predict the rates for the next 12 months, and they got a year 12 kid, right? Now, at the end of the 12 months, the year 12 kid just did just as well as the 3 economists. And so my point there is there's a lot of things that sometimes you can't predict. COVID, global financial crisis, Trump putting 125% tariffs. There's a lot of sentiment. But I think that the way that I try to prepare myself for my own investments and the guidance that I give to people is you want to shield yourself from all these fickle, exterior things. If you make a good plan and you invest in a good asset, whether it be for yield or for capital gains, I think you're pretty shielded from a lot of that stuff. But yeah, obviously interest rates is going to be an important discussion, and I generally don't like to talk about it because it can change. Like I could talk to you about a rate today and it's going to change tomorrow. So, and rates are going down. So it's always worth obviously reviewing what you've got. I think the best thing to do, so for example, if you have a loan at the moment and you know that banks are reducing their fixed rates, have a look on your current bank website to see if your rate is the same or if it's higher than whatever a new customer can get. And all you need to do is call the bank and say, hey, give me a better rate. And in most cases, they will do that. And if the bank isn't willing to move, that's the time when you would start talking to or finding a broker that will do the hard work for you and find out, see what's out there. And yeah, it's always worthwhile every 1 or 2 years to review what you've got. Yeah.
Correct. Let's talk about MeBank. MeBank is part of Bank of Queensland.
Correct, yeah.
And you guys operate all across Australia for any?
Absolutely, yeah. So I've got colleagues all around Australia. I think Northern Territory is maybe the only place that we don't have a presence, but everywhere else we've definitely got a presence. So to give you a little bit of a backstory, so ME or MeBank stands for Members Equity. We used to be owned by the industry super funds such as Hester, Host Plus, all those ones. And then a couple of years back, we got bought out by Bank of Queensland, but we operate as a completely separate entity. So I do have sort of colleagues and connections at Bank of Queensland. So sometimes if there's something that we can't do specifically, or if it fits better at Bank of Queensland, it's something that I can work out for the customer. Yeah.
Right.
Yeah.
Excellent. Great to have you. Thank you so much for your time. There you go. We just finished up another episode on property finance. We had Toar from Bank of Queensland or MeBank. Please feel free to reach us out if you have any queries on property finance. We can get you the right people on board.